So in this video, I'm going to answer the age-old question. How does LWT keep his beard looking so damn good? Well, the secret is lemon. I'm not giving away any more secrets than that, but the second biggest age-old question is how does LWT pick stocks to add to his investment portfolio? So in this video, I thought I will answer some of the very basic fundamentals that I look for in a stock to invest into long term. So if you are new here, fasten up, lube yourself up, and sit down and enjoy, because this is going to be a good one. So no fuss, how do I find stocks to buy, invest in, even sometime you could argue day trade? Well, the answers are very, very basic, and I'll cover these points. In fact, there's two very good points towards the end of this video that you should strongly look at, and I wouldn't even say they're criteria, more of investing hacks. I nearly said life hack there. You could call it a life hack, I guess. But of course, first the disclaimer, I am not a financial advisor in your area because quite frankly, YouTube doesn't pay me enough. So make sure you do your own due diligence when it comes to investing in general. And this video should not be seen as financial advice in any other way. But if you are new here, please do subscribe and turn on the bell. Please make sure that like button is turned blue. It massively, massively helps me out. If you want to support the channel and get some exclusive perks, there's a Patreon link down in the description. And if you're not from the US or Canada, there's a pinned comment down in the comment section where you can sign up, deposit, and make one simple trade with eToro if you use that link, and you get free, yes, free lifetime access to the investing chat room with LWT. Okay, moving on, that was very fast. Okay, so let's do this. Tips or criteria I look for when investing. Well, it's quite generic, to be honest, because there is set situations where, you know, you bend the rules a little bit and sometimes it works and sometimes it doesn't. And that's what you need to really think of when it comes to investing is if you thought about your company you're looking at investing in as a whole, well, you should have full conviction, but at the same time, you should be willing to cut it at any point too. Provided you're investing into a semi-decent company with a solid proven track record, then you can't really go too much wrong unless you buy the top of GameStop because, well, actually, that's not even a legitimate company anymore. But the point I was getting to there is the first criteria, and that is quite frankly, value. I'm sure you've heard the term value investor or value trader and all this other lovely stuff. And what it means, quite frankly, is you're buying stuff at a cheaper rate. It sounds pretty simple, but people don't do it, especially new investors. In fact, you hear them saying YOLO GameStop, YOLO BlackBerry or Silver or whatever else. And even in Apple and Tesla, they're actually just continuously buying highs when there's loads of good value stocks out there. In fact, there's always value. I just did a video on BP, you can go and check it out, and I'm actively looking at buying more BP because I think it is damn good value. When I look at value stocks, first thing I always look is just on the chart alone, where I'm looking at entering my first position size, which I'll come on to how I do that in a minute. Is there upside potential of at least doubling my money? Now, if we look at BP for an example again, we can see that if we bought BP at this current price and we go back to pre-pandemic levels, it's pretty much double your money, 100% move in itself. And that's what we're looking for, a company that is slightly on bad times, but nothing too much long run. Now, sticking with oil stocks, if there was an oil spillage in a big name, again, BP, Shell, Exxon, Chevron, take your pick, Total, then that's not really going to affect the company long term. So you might get a good dip. Another example is when VW, Volkswagen, did this whole diesel scandal. It's not going to bankrupt the company. They're probably going to have to pay a fine, and there's probably so much fear factored in. And in fact, that was another good investment. Now, it's not an exact science, but I will bend the rules a little bit. If there's only a 50% move to the upside, then they pay a good dividend. That I'm also interested in, believe it or not. In fact, if it's a good dividend and it's 10-20% down, Alibaba is a good example of that very recently. Although it doesn't pay a dividend, there is exceptions. Alibaba sold off massively because everybody thought Jack Ma was missing. But even if he was, Alibaba's not going anywhere and someone else would take over. And long term, the stock will bounce. It's a good company. So my point is look for value on stuff that's really oversold or undervalued. That's what value is. Buy value, not the tops of charts. But that comes straight into sort of the second section, which is catalyst. Why is it down or why is it up? Or why can it go up or why can it go down? So for example, sticking with BP again, it's oil. Oil's struggling in general because the world is not open. But one day the world will open and oil will go back. But BP is also in renewable energies, and I think that's going to be a big catalyst going forward as well. So there's multiple catalysts why BP can go up. Another example would be VW. Again, we've talked about if VW was down on a diesel emission scandal, well, long term, they're going to fix that issue and continue producing cars. So why is it down? Now, I know there's probably someone sat there thinking, well, yeah, every company that falls, should come back up, right? Well, not necessarily. Let's look at Wirecard. If you don't know who Wirecard is, I strongly suggest you go on YouTube and have a look at them. Well, basically, this company was one of the biggest financial companies in Europe. In fact, they actually lied about having a couple of billion euros on book. Crazy, I know, but it happens, right? Now, when this got found out, there was endless amounts of court cases, everybody pulled their money, and the stock price reflects that. But Wirecard, quite frankly, cannot recover from these damages. So that's a different aspect. If a company falls 90%, that's not good value. There's something fundamentally wrong. If a company's fallen 50% at a steady rate, maybe there's still some value there. But you need to do your due diligence, and that's what I'm getting at. Why is it down? If it's down because of something out of BP's control, like oil price, or VW that even isn't its control, but it can recover from, that's fine. But if it's coming down because, I don't know, fraud and the company's going to go bankrupt, that's not good value. It's pretty common sense like that. But is there a catalyst to the upside in the future coming that you think can raise that stock price up to the previous mentioned 50 to 100% gain as a bare minimum? If you think there is, then we can move on to the next step. And the next step is liquidity. Now, this is more of a day trading thing, really, when you think about it, but it is also quite important. There's many companies out there, especially on OTCs, that just don't trade volume. They can be manipulated upside or even downside, and you could have a lot of pain or a lot of luck. Whenever I'm looking at making an investment or even a day trade, liquidity is very important. Now, eyes are the most important thing when it comes to day trading. It might sound weird, but I'll tell you why. Well, for a stock to move, you need eyes on the screen watching it. If news comes out on BP and no one's watching it, it's not going to move. In fact, if it did, it'd probably be down because there's so little eyes watching it, and it's an opportunity for short sellers. So without eyes watching the stock you're looking at, as an example, some random OTC stock that trades 100, shares a day, that's not liquid. That's a dangerous move. It could go in your favor, it could not, and it's a bit of a gamble. But if you're trading a stock that's actively trading, a couple of 100,000 minimum a day, then you're all right. You can get in and out, but more importantly, people are looking for catalysts to make a trade to the upside or downside, and that's a big thing that you need, and it's very underrated when it comes to investing, in my opinion. Moving on to the next thing is sector. What sector is this industry in? I know I'm sticking with BP a lot here, but oil as a whole is undervalued, in my opinion, and the markets, when it does get going, will do well. As a whole, I'm talking about oil companies with a market cap of over a couple of billion should do quite well when the world does reopen. So that's BP as an example. VW right now is another example where car manufacturers are not selling as many cars as they should be. And that is again down to the overall sector, which we put everybody in, which is the pandemic. But individually, let's look at banks. Finance is taking a massive hit. If we look on what happened with the Robinhood thing, finance stocks are going to be very risky in that essence alone. And I think that a lot of finance banks and stuff like that are actually really over leveraged. And is that sector going to come down? Because even if, example, Barclays or HSBC was a good investment, but the whole sector comes down, that's going to affect your company as well, no matter what happens. Sectors do tend to fall in tandem with each other in some way, shape or form. And if you don't believe me, just look at the tech sector. If Apple falls 10%, usually Facebook does as well, so does Amazon, and pretty much every other tech company out there. And wait, I know Amazon's like an e-commerce company, but it is sort of tied into tech as well, so relax yourself. Now we've established sort of the core foundations. The next thing is scaling, which comes us all the way back around to value. And what I mean by that is it's massively overlooked, and I think everybody should take into account. If you've got just $1,000 in your account, for example, you shouldn't be just going all in YOLO GameStop. You should be scaling in 200 shares, 100 shares even at a time, or $100 at a time, or $200 at a time, and scaling in and hoping for big dips. And if them dips don't come and your stock goes to the moon, yeah, that didn't happen with GameStop, by the way. But if it does YOLO and go to the moon and you've only got like 20% size, that's cool. Diversify, look for the next one. Because that's what investing is about. You're only as good as your last trade to an extent, but if you're all in with that last trade, you're going to miss other trades. And that'll come on to the final tip, which I'll come on to in just a minute. Now me, for example, if I'm looking at buying 1,000 shares in said BP, I'll probably look at buying 100 shares or 200 share positions and scaling up. But in the back of my head, I will know 1,000 shares is my limit on BP, because I'll write it down in my calendar and that's what I know. And it's the same whenever I take an investment. I know I'm not going all in on that ticker instantly. I mean, for example, right now, bit of a spoiler alert here, I've got quite a lot of GSK, and I've had a lot of GSK in the past. I might have fucked up there. Am I allowed to swear? Well, I just did. It's my channel. Yeah, I fucked up on GSK because I sized in too quick. I sized in really, really quickly, and I didn't get a good average. And I was okay. I got my dividend. I didn't lose money. I made like 5%, but it was 5% in about 6 months. That's not good enough for me, and I was very disappointed with it. Got a bit of FOMO on a dip, and I should have scaled in and got a much better average. But no one's perfect. But that's my point. Buy little pieces at a time in big dips. And if you don't get them dips, have 7 or 8 stocks on your radar and buy them on big dips. And then all of a sudden, you've got yourself a diversified portfolio. Clap, clap, clap. You're just as good as everybody else on Wall Street. Whoa, whoa, whoa. Don't say Wall Street. The apes will get angry. Now, I did promise you 2 big tips. And the first one I just touched on, which is diversification. Everyone sort of overlooks diversification, especially new investors. And I know most people watching this are not going to listen. They're going to YOLO with leverage. But diversification is key. And what I mean by that is scaling in leads to diversification, because other opportunities come up. And as them other opportunities come up, you can then size into other stocks. And then you've got 2 horses in the race. And before you know it, you've got 3 horses in the race. And you're not just relying on that one stock to go to the moon. You're actually looking at 3 stocks, and your friends at work will be like, hey, what are you looking at? And you're like, this, this, and this, rather than just, yeah, I'm in GameStop. You know, diversification is key. And another big tip is never have more than 20%, not only in one stock, but in one industry. 20% of your portfolio should never be in one industry. And it's a very, very crazy thing if you are overexposed into just say tech, you know, or oil, or pharma, or banks. Diversify. There's no harm in it. Every sector has an undervalued stock right now. I guarantee you, every single sector has an undervalued stock somewhere. It just needs to be found by you. Now the biggest tip, and it's a tip that I don't think anyone has ever talked about in the history of YouTube. That might be a bit of a lie. Cash. You should always keep some cash in your account. And that might sound counterproductive because it's not working for you. And I can imagine like one of my favorite YouTubers, Gray and Stefan, going, you should be invested. It should be working hard for you. And I get that. But I mean, it doesn't have to be cash. You can buy a currency or something that barely moves or something that just pays you a 2%, you know, interest a year. But you should always have cash in account. Again, coming back to those YOLO game stoppers with leverage, you quite frankly, if you had cash in your account, you could look for the next one, which would be Silver or BlackBerry or AMC or whatever else they're trying to pump. But you could quite easily have a diversified portfolio without even knowing it. And you can't do that without having cash. For example, I'm probably about more, well, maybe just less than 50% in cash in my total investing portfolio. Now that is actually actively growing because there's a few positions I'm looking at taking off in the next couple of weeks. But it's a good example because I go to bed, wake up, look for an opportunity, and I know I don't have to sell the stock to buy another one. And it's a nice feeling, okay? But more importantly, all the stocks I'm in, I'm not in full size either, but the cash is there ready to go. Now it might sound counterproductive, but let me put it another way. You could sell a winner, a trade that's working for you. Cineworld is a good example. In my portfolio, I'm giving away all my portfolio here. I shouldn't really do this, but I'm up like 200% on my Cineworld investment, right? And imagine if I didn't have any cash and I sold that to go and buy Lockheed Martin, which I'm also interested in, by the way. I am actually giving out too much information. But if I sell a winner to buy this one, I could be stuck in this one for two months, 6 months, whatever. And Cineworld could, you know, YOLO moon, 8 hands, strong diamond hands, whatever it is, right? So that's what I'm trying to get at is if you had cash in account, you can have both in a way. Just don't go in full size in one ticker. But more importantly, don't sell a winner to buy another winner because that winner that you're buying could well be a loser. So let your winners run and stick to your plan is the main thing. But long story short, try to keep some cash in your account for these opportunities that do arise. Big example is recently Alibaba had this big massive drop, like I said, with Jack Ma going missing. Luckily, I had some cash around, put some money in, and I'm up like 20% on it or something crazy like that. But that's because of a cheeky little ETF I had locked away for Christmas. Well, it wasn't Christmas, but you know what I'm saying. Anyway, I hope you found these tips helpful. So if you are watching this far, can you just comment the word sponge in the comments? Random, but sponge. Well, it's not that random, but you know, it's quite echoey in here. I've got a lot of sponge. So can you go down, just comment sponge. Please make sure that like button is turned blue. If you haven't done so already, subscribe, turn on the bell, sign up with eToro on the pinned comment. See you in the next one. Take care. Peace.